Tom Lee, no surprise, bullish, right? He's not wavering, even with the churn that we've been seeing and some of the activity. And we said we're not all that far away from new highs as we continue to move higher today. He says, quote, we still believe equities are risk on. We see the S&P 500 reaching 4,400 by the first half of 2021. Remember, he had pulled forward his optimistic expectations for stocks. That's in the next 4 weeks, going to 44. And then we'll see. And it's going to be led by epicenter stocks. Did the jobs report just give the rally that excuse to take that next leg higher?
You know, it sure may have, Scott. I mean, it feels that way. We watched it move the second we got that jobs report. So I would say the reaction was exactly that. And I think Liz broke it down very nicely. I mean, the idea that the Fed's watching, they are data dependent. They'll be continuing to watch. But as of now, it's just steady as she goes. And that's exactly what we are seeing. And that's a very big positive thing, I think, generally thought for the markets themselves. And we're seeing the NASDAQ really outperform. They're both performing very nicely. The Dow, the NASDAQ, the S&P as well, throw that in there. But the NASDAQ has certainly been the leadership today. And, you know, each and every day we see different leadership. But the strength that we're seeing out of the NASDAQ today does make a statement to me that folks are very comfortable with some of these growth stocks, with some of these very speculative stocks, and that's exactly what we're seeing today. And you look at volatility, Scott, volatility is once again starting to creep that much lower. Even with some of the crazy moves that we've had in different sections of the market, we are watching volatility just kind of ease back into those teens and now into the 16s. It tells me that people are feeling very, very comfortable right now. Well, whether they should be or not, that's something for the future.
Well, I mean, maybe they should be, Shannon, by virtue of a jobs report that suggests there's a long way to go. And the Fed probably reads that and thinks the same thing and says we're going to be patient regardless of what the market thinks or what the market wants. Rates have not been exploding higher. So why shouldn't we be comfortable investing in growth and investing in tech as long as the environment remains as what I just said it will?
I think there's a counter argument to that. And again, with the way that we're structured in our portfolios, we're certainly barbelled to some cyclical exposure as well as plenty of quality tech. So, I don't want to speak out of both sides of my mouth, but I would say we're coming into a difficult period here. So we've got about 4 weeks till the end of the quarter, 3 weeks or so, and we're not going to have any, earnings season's over, essentially. We have a few more reports next week. And so I think it's important that each of these successive data points is going to be important because every single time we get a piece of economic data, we're going to be thinking about, is the housing market slowing? Is inflation creeping higher? This jobs report, we're continuing to look at claims on a weekly basis. Now we're going to start to take all of these data points and go down to the second and third levels. Where are the jobs coming from? Are there areas of the market or areas of the economy that have rebounded quickly over the course of the last few months? Is that rebound slowing? Are we getting any sort of plateauing? So I don't disagree with Tom's enthusiasm about the potential for a tailwind in the Fed, coupling with just an improving economic environment, as well as a clear sense of reopening. If anybody has been to a restaurant in the last several days in some of the states that were not as open, but I do want to caution that there could be some fits and starts here over the next 4 weeks or so, just because the only thing that we have to look at is economic data.
So, Farmer Jim, if I were to tell you, okay, we're still 7.5 million jobs light, right, from pre-pandemic levels. Fed doesn't go to Jackson Hole until later in the summer, and that you would think would be the time that they would lay the groundwork for any taper talk if there was one publicly. That leaves a little bit of a runway here, does it not?
It leaves runway, Scott, in which I think we're going to be stuck in the mud. And this is what I said to you, I think, last week. I think you got a few weeks, at least, maybe more, of sideways trading here.
Why?
Here's a fun fact.
Why?
Why, here's right? a fun fact.
I think that's what
because you're going to get no resolution.
No, I'll give you a second.
You're going to get no resolution.
Oh my God! I'll come back to you in a second. But why wouldn't you be on more, to use your analogy, more solid footing? Right? If the environment I just said is like, okay, you don't have to worry about the Fed, and you don't have to worry about rates rocketing and maybe inflation ripping. Why isn't it more solid footing rather than mud?
because you have no resolution. You have no solid ground. You have no resolution on inflation. 4 business days from now, we're going to get the CPI. Remember what happened last month? You had a weak jobs report, the market ripped, and then 4 days later you got the CPI and it was much hotter than expected. The market tanked. Now, I don't know what CPI is going to be next week, but I suspect it's not going to be tame. So there's no resolution on inflation. There's no resolution on taxes. There's no resolution on infrastructure spending. I don't think you're going to get any catalyst to move this market higher until second quarter earnings season. And maybe even that's not enough because we saw what happened first quarter. But I do think second quarter earnings will be positive and possibly will break us out of the mud. But that's a month away. I think we're sideways. There's no resolution in the next month on any of the factors that are facing the market.